Okay. Good morning, CIFA members. Welcome to our webinar in which the so-called UNSHELL directive will be discussed. As you know, CIFA aims to host webinars on a regular basis to keep members informed and up to date of recent developments and trending topics affecting the financial services sector. It is with great pleasure that today we welcome Professor Daniel Smith and Mr. Terence Menendez as our guest speakers. Daniel Smith is a professor of taxation of the digital economy at the University of Amsterdam and also the head of the Tax Knowledge Center of EY in the Netherlands. Terence Menendez is an executive director at EY. He is the Caribbean tax desk leader and he is based in EY in New York. So as you know, in December 2021, the European Commission published a draft directive aimed at the misuse of so-called shell entities. The draft directive, amongst others, aims at introducing an EU-wide substance test and currently proposes substantial additional compliance and reporting obligations for the businesses affected. In this webinar, Daniel and Terence will outline the potential implications of the directive on businesses in the EU and also the possible impact of the provisions of the directive on businesses in the Caribbean in general, and Curacao specifically will also be addressed. The session is planned to last about an hour. You can pose your questions in the Q&A box during the session, and there will be an opportunity for a Q&A at the end of the session. Daniel and Terence, thank you again for your time today and willingness to do this webinar for our CIFA members. The floor is yours.
Hey, thank you, Raisa, and good morning, everyone. I don't think I have to tell anyone that works in the financial sector how important having the right substance has become over recent years. In fact, I remember Daniel and I giving a seminar around substance back in Avila, pre-COVID days. Unfortunately, we didn't get to go to Avila this time, but maybe next time we'll see. But what makes this webcast different, though, is that the substance requirements that we discussed in the past were mainly those imposed by the OECD in connection with the BEPS action plan and action point number 5 specifically. However, the substance requirements that we will discuss today come from the EU and are targeting the so-called EU shell companies specifically. The first question that comes to mind here is, are the OECD and the EU substance requirements exactly the same, somewhat similar, or completely different, right? Before we elaborate on that question, though, we will take a look back on the evolution and recent developments in the area of substance and transparency, and shortly discuss not only how Curacao has dealt with this, but also other Caribbean jurisdictions for a broader and complete picture. And then Daniel will zoom in on the EU-issued UNSHELL directive, also referred to as the ATAD 3 directive, to discuss how this works, but also to inform you how, for example, some of your colleagues in the trust sector in the Netherlands could be impacted should this directive be enacted. Then we will bring it all back closer to home by briefly discussing why these substance-related developments in the EU could be relevant for Caribbean countries in general, and of course, for Curacao specifically. So, Daniel, I forgot to ask you to skip to the agenda because that was actually the agenda, right? We're going to take a step back to see everything that we've gone through recently, and then Daniel will take it up further, and then we'll wrap it all up at the end, as Raisa pointed out, with some time for a Q&A. Okay, next slide, please, Daniel. Yes, perfect. So as we go back to remind ourselves why we had to change our tax legislation and introduce substance requirements and all of that in the first place, I would like to start with BEPS action point number 5. Of course, we are not discussing this action point in detail, but in short, action point 5 of the OECD action plan addressed the countering of harmful and preferential tax regimes by committing to improving transparency between jurisdictions, including compulsory spontaneous exchange of tax rulings, and requiring substantial activity, meaning substance, for any preferential regime. So we're talking about IP regimes and non-IP regimes here. As part of Action 5, the FHTP, that's the OECD's Forum on Harmful Tax Practices, which we know in Curacao very well, The FHTP has been conducting reviews of preferential regimes in order to determine if the regimes could be considered harmful or shouldn't. In this regard, the work of the FHTP comprises of three areas, being the assessment of preferential tax regimes to identify harmful features such as ring fencing, low tax rates, lack of transparency, lack of substance, for example, name a few. Secondly, the peer review and monitoring of the Action 5 transparency framework to make sure that that's going well. And lastly, the review of substance requirements in a different group. It's called the no or only nominal tax jurisdictions, that group, to ensure a level playing field. What we see is actually through 2021, the FHTP has reviewed over 300 tax regimes, including several in Caribbean countries such as Barbados, Curacao, Aruba, Dominica, just to name a few. And I think it's safe to say that the impact of BEPS Action 5 on these Caribbean jurisdictions has been significant. Through the course of 2018 and 19, these jurisdictions have put a lot of effort into revising their tax regimes that were considered harmful, and in some cases, also decided to abolish them to replace them by new ones. We are talking about IP regimes that have been replaced by regimes that meet the FHTP standards by making sure that they are in line with the nexus approach, as we have done in Curacao. But we're also talking about regimes for financing, leasing, holding, and insurance activities, for example. Also, different free trade zones across Caribbean were deemed harmful, often due to ring fencing issues, making countries such as Aruba, Dominican Republic, Jamaica, and also Curacao again having to revise these. One other country that basically did a complete overhaul of their tax system by abolishing their IBC regime and introducing a new tax system is Barbados. And again, the same applies to Curacao. We switched from a worldwide tax system to a territorial tax system as of 2020. In fact, we all remember that we had to revise our profit tax system twice, since even though the system that we introduced in 2018 and 2019, 18-19 was approved by the FHTP, it was not in line with the requirements of the Code of Conduct Group of the EU, because the COCG had a stricter interpretation of ring fencing. So Curacao had to revise its tax system again as per 2020. So this is actually a great example of the implications that a jurisdiction will have to endure when the OECD and the EU are not completely aligned on the specific matter, right? So, and of course, as you know, we also introduced substance requirements for our different tax regimes. However, we now see that the legislative dust has somewhat settled, so to speak, and that all these new tax regimes in the Caribbean are supposed to be in line with OECD standards, and of course, for now include all the substance requirements. And of course, we will take a deeper dive into these substance requirements later on. But this also applies to the 7 Caribbean countries on the FHTP's list of no or only nominal tax jurisdictions, being Anguilla, Bahamas, Barbados, Bermuda, BVI, Cayman, Turks and Caicos. Not only have these jurisdictions all introduced substance requirements, but they already started exchanging information on the FHTP's global standard on substantial activities on 31st of March of last year. Right, so a lot of transparency going on there already. So the tax administrations receiving all this information in other jurisdictions are now able to carry out risk assessments and apply their own CFC rules, transfer pricing rules, and other base erosion and profit shifting provisions as they deem necessary. So again, you see there's a lot of transparency going on there. So again, there's really a lot has been happening, and I know that the focus of this presentation is on the UNSHELL directive, so I don't want to take up too much time, but I do want to point out quickly that following the efforts of some of these Caribbean jurisdictions in recent years, specifically Barbados, Cayman, Anguilla, and Dominica, they all have been removed from EU's own list of non-cooperative jurisdiction for tax purposes. In some cases, still subject to further review and monitoring, but they are off the main list. So this is basically another example of how jurisdictions should not only consider the OECD push developments, but also track what the EU wants. So the message that I want to bring across here is that we have put in a lot of work to make sure that our tax legislation and substance requirements, etc., are up to par, mainly because of OECD requirements. but there are also a lot of developments that are currently pushed by the EU, and we should monitor those closely because they could require us to make additional adjustment to our tax system going forward. And that is actually why we're really happy that Daniel is able to join us today to talk us through these EU developments and focus on the UNSHELL directive specifically. Thank you, Daniel.
Thank you, Terence. Thank you very much, and also thank you for inviting me. It's a big pleasure. Good morning, everybody. Yes, I want to guide you a little bit through the UNSHELL directive proposal. Before we do that, I want to stress just a couple of things. First of all, it's at this current stage only a proposal. That means that things can still change. So what I'm going to discuss with you today, it's kind of a snapshot about the current state of affairs. But as said, we don't know, well, we expect this proposal eventually to go into fly. We expect member states that they eventually will adopt it, but we don't know exactly in which form and in which content-wise how the final directive will look like. So what I'm going to discuss is, that's, as I said, it's a snapshot. It may change going forward. Secondly, you may wonder, why should we be interested in discussing an EU directive, since the Caribbean, Curacao, Aruba, it's not part of the EU. At least they're not bound to this directive eventually. That's true. But as we have seen earlier, and Terence also referred to that, we've seen that once member states within the EU manage to come to some sort of harmonization in the field of fighting tax avoidance or fighting tax competition, once they agree on setting some sort of minimum standards, the next thing we've seen in the past member states may do is start to, let's say, exporting these minimum standards to non-EU countries. And member states may do that, well, based on political peer pressure, but they may use, as they did in the past, member states may start using the EU blacklist, requiring non-EU countries to meet some minimum substance standards in order to avoid being placed on this so-called blacklist. So that is the, let's say, the exposure that this UNSHELL directive eventually could have on non-EU countries as well. And this is why it actually is important, because once the member states agree on defining substance of intermediate companies, it may very well be that, you know, the next day also non-EU countries will be required to meet these standards. And if they don't do so, they may be put on this blacklist. Finally, just briefly, this UNSHELL directive, it's not something that comes out of the blue, and also it's not the only proposal currently pending. The EU currently is very, very active in setting the scene in terms of fighting harmful tax competition, fighting tax avoidance, also actually in creating a business-friendly climate. Recently, we've seen a proposal on allowance on equity. And this is just a brief overview of what all is going on currently. And you see it's a lot. The EU is very, very busy. I think the main message here is, at least from an EU perspective, but also more broadly for non-EU countries, you really need to make sure that you that you keep the big picture into account. So it's good we focus today on the UNSHELL directive, but bear in mind there are also other developments going on. Most importantly, perhaps the Pillar 2 directive. So you may pass all the substance tests under the UNSHELL, maybe eventually, but what about Pillar 2? You may still be exposed to some sort of top-up tax if you have a too low effective tax rate. So all these proposals you are seeing here, they all interact in one way or another with each other, and you really need to make sure that you keep the total overview. Well, that said, let's now continue and focus on the UNSHELL directive proposal only, but just bearing in mind that this is just one piece of a bigger picture. What is the UNSHELL directive all about? Well, basically, it's about fighting shell companies. It's about fighting empty or almost empty intermediate companies in international structures. letterbox companies, as often mentioned, sham companies. And this is very generally, it's not focused, the proposal is not focused only on multinationals, for example. It also focuses on shell companies held by individuals, by wealthy individuals. Actually, the scope of application is really broad. It just applies to all companies in an international setting. And the aim really is to attack these kind of intermediate companies used in international structures. What is the key message that actually this directive or the Commission wants to throw in the world? Well, the key message essentially is you need to make sure that you have substance. If you use an intermediate company in an international structure, but not only substance, it needs to be your own substance. It needs to be, you need to make sure an intermediate company has own premises, own employees, its own directors. That's the key message, meaning if you are outsourcing certain board activities, for example, you are outsourcing the management, the management of the intermediate company, you are exposed. You may have a problem under this UNSHELL directive. So outsourcing of management and activities may be problematic under this proposal. So the focus really is on creating or making sure intermediate company create their own substance. Now, how does the directive operate? Basically, it's some sort of filtering methodology that the UNSHELL directive uses. We start with the first test, which is called the gateway test. Are you in or out of scope of this directive? If you meet certain criteria, you will see, next slide, if you go to the next slide in a second, you will see that you may be in scope. What is then the consequence? If you are in scope, you need to report to your local tax authorities to what extent you meet the UNSHELL directive substance criteria. Then the local authorities will decide whether or not you qualify as a shell company or not as a shell company. So this is in the jurisdiction where the shell company is located. If the tax authorities decide you are not a shell based on the criteria posed by the directive, you are basically out of, well, you're no longer exposed, but still the tax authorities of this intermediate, of the country of the intermediate company will start exchanging information about your substance to the other member states involved. So even although you're not qualified as a shell, still there will be exchange of information to other member states. If the member states decide you are a shell company based on the criteria provided by the directive, you will be labeled as a shell entity. Again, you will have this exchange of information to other countries. And then we go to the next step. Then there is this rebuttal possibility where the taxpayer, the intermediate company, can say, look, although I do not meet all the specific tests provided by the directive, still I have commercial reasons to set up the structure like it is. So the taxpayer is given an opportunity to provide proof to the contrary that it has commercial sufficient substance in the country of the intermediate company. On top of that, and then we are in point 5, the intermediate company also has the opportunity to prove that there was the structure, including the intermediate company, did not lead to a tax benefit. So you are able to show that your motive to set up the structure as it is, including the intermediate company, was not set up for tax purposes because apparently there was no tax benefit. Without the intermediate company, the tax burden would have been the same. And then if you can demonstrate that there's no tax benefit deriving from the intermediate company, you should be safe as well, but still safe in the meaning that you're no longer qualified as a shell, but still there will be this exchange of information mechanism being applied. If you don't pass the rebuttal of presumption, if you cannot prove that you have sufficient economic activity, if you cannot prove that you have no tax benefit, yeah, then the countermeasures kick in, and those countermeasures are quite severe. It means a top-up tax, well, not even top-up tax, it just means a compensatory taxation either in a member state where the parent company is located or in a member state from which the payments are made, the payments received by the intermediate company. And you look to the country where the payments are being made, and that country, the source country, is then required to impose a withholding tax on the payments made to the intermediate company. So either you may have a compensatory taxation in a shareholder country, alternatively in the source country, the country where the payments are being made. And those countermeasures really bite. So yeah, ideally, you really want to avoid those countermeasures. And a final remark, going back quickly to the reporting, failure to report on your substance criteria may cause severe penalties. I think the directive mentioned, if I'm not mistaken, 5% based on your turnover. That's the amount. That's how the amount of the penalty is calculated. So if you didn't report, whereas the local tax authorities think you should have reported, then you are at risk to get severe penalties. And this all together makes the directive kind of something not to underestimate. You really need to carefully check all the tests. You go through the filter, and you actually really must be sure that you pass the test. And if you are in doubt, for example, the gateway test, if you are in doubt whether you should report or not, well, I would say better safe than sorry. Perhaps you should report, because otherwise you risk severe penalty risks. This is in a nutshell, and I'll go into a bit more detail. We are fine time-wise, so I can go in a bit more detail on the separate steps. But maybe just before we start, let's go to the substance criteria, because that's essential for this directive. You need to have sufficient substance in terms of this directive. Unfortunately, Termens, you already referred to substance OECD-wise versus substance EU-wise. Is that the same? That was the question raised. But unfortunately, even within this directive, there's no one single concept of substance. You have a substance test under test 1, under your gateway test. Then you have another substance test under test 2. You look to different criteria. Then in terms of the rebuttal, you also have a substance test, but that substance test in terms of the rebuttal, is a different test than the reporting or the gateway test. So you have different kinds of substance tests within one and the same UNSHELL directive, which is really, really, I think, problematic. And I would say to the Commission, try to make things a bit more simple and try to keep to one single concept of substance. Don't start working with different concepts of substance, because that's very, very confusing. But at the current proposal, that's how the directive is drafted. We have substance, but not one single concept. We have different concepts. Now let's just go to the next slides and just go in a bit more detail through the 7 steps. The first step, the gateway test, is actually the most important one, because this test determines whether you're in or out of scope of the UNSHELL directive. If you're out of scope, that's good, because there will be no exchange of information, there will be no reporting and publication, there will be no countermeasures. So ideally, you stay out of the gateway test. But the criteria to qualify are quite easily met, actually, because when do you fall under this test? First of all, if you receive primarily international, if you primarily receive, let's say, geographically mobile income, passive income, but income actually can also be passive, but think of dividends, interest, royalties, intragroup services, lease payments, etc., etc. Secondly, you need to be engaged in cross-border activities. So if you receive this type of income from another country, you may very well meet the second test. The third test, it's the most important. Under the third test, you look, as I started, you look whether your own administration, meaning your management of a company, is outsourced or in-house. If you have outsourced your management, you fail under the gateway test. If you have your management in-house, so your own employees, your own people doing the management of a company, then you are safe. Then you will fall, you will not qualify under this third test. So in brief, international passive income received by a company that has outsourced its administration fails under the gateway test and will be in scope of the UNSHELL directive, meaning you have to report. And what do you have to report? Well, three things. You have to report whether or not you have your own premises in a member state where you are located as an intermediate. You have to report that you have at least one active bank account within the EU. And this third one is also, again, important. You need to demonstrate that you have at least one qualified director, or that the majority of the full-time equivalent employees are resident for tax purposes in the member state of the undertaking. What is qualified? When are you qualified? A qualified director? You're a qualified director first if you have the, let's say, functional capacities to perform the management regarding the activities of the intermediate company. So you need to have the proper skills to carry on your activities as a director. But more important, this director is not allowed to be a director for other third-party companies. So meaning you cannot share your director with other enterprises. The director has to be your own director, so to speak. So a director that is qualified, but who is providing services for you as an intermediate, but also services for another unrelated intermediate company, will not qualify under this test, meaning that you will qualify as a shell company. So that is, I think, very important. Outsourcing, that's important criteria. But in terms of the reporting substance criteria, I think crucial for practice is that your director has to be your own director and not someone shared by other companies. Just going briefly one step back, because I said the gateway test is maybe easily met. However, there in the EU, at least, there are some exemptions for specific situations. For example, small, medium enterprises are excluded as long as almost all activities and the relevant shareholder are located in the same member state. The same applies for specific financial entities. They may be excluded under the UNSHELL directive. Also, multinational enterprises, large multinational enterprises that fall under country-by-country reporting, typically may be excluded under this proposal. So, especially small, medium enterprises or very large enterprises, they may not be hit by this directive. But typically, typically companies with no real activities, investment companies with outsourced management, well, they are really at risk, I would say, under this directive. Let's move on to the third step. Second and third step, that's depicted here on the screen. As said, this is what the intermediate company should report to the local tax authorities. They should report information about these three criteria and also about the outsourcing criteria. And then it's up to the local tax authorities to assess whether this company qualifies as a shell or not. Well, if you're qualified as a non-shell entity, then you will not be hit by the countermeasures, but still there will be exchange of information. So the other countries involved where the payments are being made may be informed, look, you're paying to a company that was in scope of the UNSHELL, who passed the reporting requirements, but still we wanted to let you know. And then the local country also always can think, well, okay, maybe it's not a shell company in the meaning of the ATET, but in the UNSHELL directive, but maybe there is a principal purpose issue here, or maybe there's another anti-avoidance rule that could be applied. So that's, of course, in practice, not something that you want. If there's exchange of information, for some countries that may as such function as some sort of red flag. Even if there's nothing wrong, local countries may still think, whoa, we get information, probably there's something fishy here, let's just check, let's do an audit. Or so ideally, as said, you want to avoid exchange of information. Well, if the local tax authorities do not qualify the intermediate company as a shell, then we enter into the rebuttal, which actually says if the intermediate company can demonstrate that it meets, well, I would say, and the standard here is quite high, because I think the final bullet is the most crucial one. The intermediate company typically should demonstrate that the decision-making powers and processes are in substance located in the country where the intermediate company is located. So this is a very, I would say, it's not a legal approach, it's a more functional transfer pricing-like approach. You really need to assess who of all of the people working for or on behalf of the shell company, what exactly are the responsibilities and of these people, and actually what is the decision-making power of these people? To what extent can these people decide autonomously about the activities, the income-generating activities? And again, this is more a kind of transfer pricing test, significant people functions test. It's not so much a legal approach. And I'm not sure whether in practice this threshold will be met easily. As said, it's a more economic approach. And also the wording of the directive is not fully clear, because, well, actually, if you read it literally, this more economic approach, the significant people functions approach, seems to be an all or nothing test. So it seems to be that either you meet this test or you don't meet it. Meet the test. If you don't meet the significant people functions test in a meeting, that you cannot demonstrate that the real decision-making power is at the level of the intermediate company. But if you still have other commercial motives, good commercial reasons to locate an intermediate company in a given jurisdiction, so you don't meet the economic significant people functions test, but you do have commercial reasons, literally speaking, you don't meet this rebuttal test, because it seems literally that you just need to have sufficient economic substance. This is a bit harsh, and I think maybe this is not intentional. So maybe the rebuttal will be rephrased during the upcoming negotiations, because I would actually I think that this will more serve as a safe harbor rule. If you meet this significant people functions test, then in any case you are fine, you're good. If not, well, we have to look to other commercial reasons, but it shouldn't be an all or nothing test. It should, I think, it should have been phrased as a safe harbor test. But as it is phrased currently in the directive proposal, it seems to be an all or nothing test, which again raises the bar to pass the rebuttal test very high for the taxpayer. We have to see how this will evolve during the negotiations. I hope that this point will be clarified and that it will be made clear that this is only a safe harbor, not an all or nothing. Then finally, rebuttal if there is no tax motive, if there's no tax benefits by using the shell. And this is a very easy example that we have been depicted here on the screen. Assume you pay dividend to an EU shell held by a US parent, and you claim, for example, the EU parent subsidiary directive exemption or tax treaty benefit, there will be no withholding tax consequently on a dividend payment. But assume that without the intermediate company, you could also have claimed, let's say, based on the US tax treaty, a 0% withholding tax. Well, then apparently there's no difference tax-wise between the intermediate scenario and the scenario where you don't have the intermediate company. So apparently then you could say, well, there's no tax benefit, at least not from the EU OPCO country. The question here is whether this motive test should be applied per country. In that case, obviously, there's no tax benefit, you could say. or whether you should apply this tax motive test on an overall basis, taking into account not only the effective taxes being paid in the source country, but also, for example, in the shareholder country. So assume you are deferring taxes by using an intermediate company in this left scenario. So it's not so much about saving local withholding taxes because you wouldn't pay them anyway, but it's about deferring taxes in the US. The question is whether that would be a red flag under the tax motive test. If you say it's a per country test, well, I think it's not, should not be a red flag. It's just you are only look whether you are saving taxes in the EU OPCO country. If it's an overall test, the outcome may be different. If you're deferring taxes in the US, well, obviously you have a tax benefit. This is a question, really important one actually, which has not been solved, but there's no clarification in the directive how to apply this test. So we simply don't know. And again, we must hope that the member states will clarify this, how this tax operates. And also whether taxes also only include corporate income taxes, or maybe also other taxes like, you know, real estate taxes or maybe VAT. We don't know, but it's very important to have a clear idea of what taxes actually are in the context of this directive. Finally, if you fail the rebuttal test, you get hit by the countermeasures. And this is, there are two examples I already mentioned. The countermeasures are twofold. The default rule is actually that there will be a compulsory taxation, a pick-up taxation in the country of the shareholder of the shell. But of course, in this picture, the shareholder is not EU, it's located in the US. If that's the case, the secondary rule kicks in, and that is withholding tax, mandatory withholding tax in the source country, the country from which the payment to the intermediate company is made. So here, we are in the second scenario, no pickup in the parent level, but we have a source withholding tax, mandatory withholding tax in the EU OPCO country. That's the countermeasure that follows from the directive. There may be tax-free protection, but the rules, again, are not clearly drafted in that respect, but you may probably argue that if you have to ignore the intermediate company here, the EU OPCO country has to apply withholding tax, but taking into account the tax treaty, if applicable, between the US and the EU OPCO country. So that's what seems to be the idea under the directive. So you still have some sort of safety net that you could apply the tax treaty with the US, but again, that's not totally clearly drafted. What about the EU shell company actually? Are there countermeasures in the EU shell company? Well, actually not really. The only thing is that the member state of the EU shell company should no longer issue a certificate of residence to that shell company. Or if it does provide a certificate of residence, there should be a warning statement included saying, look, this is a shell company in the meaning of the UNSHELL directive. But there will be no mandatory taxation in the EU intermediate company jurisdiction. Of course, it's up to that country to apply some sort of compulsory tax, but it's not mandatory. Then the next slide, it's the reverse. Now we do have an EU shareholder holding an EU intermediate company receiving that income. So the shell now here is in the middle. Then the directive says, again, the EU shell jurisdiction should no longer issue a certificate of residence. And then the countermeasures kick in at the level of the shareholder country, meaning a pickup of the tainted income received by the shell company. So there's some sort of CFC-like mechanism that kind of picks up the income and imports the income to the shareholder country, subject to local corporate income tax. So these countermeasures are quite severe, and there may be double taxation. Even if you're really in a bad luck situation, there even may be triple taxation. So you really want to avoid this kind of countermeasures. Well, why does this matter now? Well, as said, for Caribbean countries, maybe it's not of immediate relevance in the meaning that, you know, this is a directive restricted to member states. But if we look to the time frame, the proposed entry into effect of this directive, it's January 2024, which is 1.5 years from now, approximately. So this, if it's adopted, this may come quite very soon. And on top of that, I didn't mention it, but in some cases, there is a look back period when measuring your substance. For example, for the question whether or not you outsourced your own administration, you have to look back to the past 2 years, meaning that the period 2022, 2023 becomes already relevant now when assessing in 2024 whether you meet the outsourcing test. And that's, well, quite significant, I would say, because it means that you already, at least if you fall within the EU, if you may fall into scope of this directive, you already have to start about thinking you're restructuring your substance right now, because if you don't do it, if you do it, let's say December 23, you may be too late because of this 2-year look back period. So effectively, you could say there's some sort of retroactivity implemented in this directive, which you should take into account already now. Yeah, I think the other points here, this is already what I mentioned. Typically, the EU has acted as a front runner over the past 5 to 10 years when it comes to BEPS measures. And typically what you see that the EU acts as a front runner and then tries to require non-EU member states to do the same. And there we have the EU blacklist, the experience that you also had, that the Commission and the member states said to Curaçao government, look, you have to change your local tax rules, otherwise you will be placed on a blacklist. And this is what I expect going to happen again once this directive is adopted. Yeah, I think I should leave it here, Terence. And then maybe we make the link with Curaçao to check whether these substance requirements are aligned with your local rules or not.
Exactly. Yeah, thank you, Daniel. Well, we see in the Caribbean region that most countries do not have an extensive treaty network, with some exceptions, of course, for like Barbados. We also see that most of these jurisdictions that are being used in the international context do not have any withholding taxes, like Curaçao, for example. And when you consider that and the usual flow of payments in these international structures, Daniel, we can go to the next slide.
Yeah,
please. Thanks. When you consider those facts, I think you can reach the conclusion, like Daniel also pointed out, that the draft UNSHELL directive should not have much of an impact at the level of the Caribbean entity itself, of the Curaçao entity, since we did not often require a tax residency certificate from the EU country anyways. With that being said, though, we are not completely out of the woods. Like Daniel explained, once the EU has a standard approach in place for dealing with substance for EU entities, it will only be a matter of time before they tackle shell entities outside of the EU as well. And one way to do that is to, for example, introduce an EU withholding tax on payments to shell entities outside of the EU, for example. So even though we already have plenty of developments going on in the international tax arena, we should definitely keep an eye on these EU developments as well. Initially, you would think that it really shouldn't matter too much, since thanks to Action 5 of the OECD, Caribbean countries already require the taxpayers to have sufficient substance and to make use of a preferential, when they make use of a preferential or a low or a non-tax regime, right? However, when you compare the substance requirements as explained by Daniel for 8.3, you will notice that these do not completely line up with the substantial activities as required by the OECD. I mean, since Action 5, we have seen in practice that, for example, if you take a Curaçao investment company as an example, we would appoint a resident qualifying individual as the managing director of the financing company and make sure that this person performs the core income generating activities locally. With respect to financing, the core income generating activities could include raising funds, managing credit and currency risks, providing loans and preparing regulatory reports and returns, etc., just to name a few examples, as listed by the OECD in their 2017 progress report on preferential regimes. That person might also manage a bank account from that jurisdiction, from Curaçao in this example. However, when you take a closer look at these substance requirements as introduced in the Caribbean countries and in Curacao, you will notice that not all require that the taxpayer has premises available for its exclusive use, like suggested in step 2 of the UNSHELL directive. You can see those two compared here on the slide. So that's one difference already for the CIC, for example. You don't necessarily have to have one premises to your, available for your own use exclusively. So also some of these taxpayers may have bank accounts that are managed from the respective jurisdiction, like Curacao again, but do not actually have a bank account or not necessarily have an active bank account in Curacao where they are established. So you see that even though that they do meet OECD substantial activities test, they might not meet the EU substance test if they should have to in the future. So this is something to wonder. You can also wonder what should be considered core income generating activities by EU standards. In the directive, it says that the substance requirements are drawn on the international standards on substantial economic activities. So you would think that this would be in line with the OECD interpretation and examples, but this is also that something that we will have to see. So as we've seen in the past. So also the OECD Action 5 report says that there is less concern of pure equity holding companies being used for base erosion and profit shifting. I am not sure whether the EU would take the same stance towards non-EU pure equity holding companies though. So I guess the message that I want to bring across here is that we should really keep good track of the EU developments and basically beyond the current UNSHELL initiatives. And keep in mind that in some cases, the level of substance that we currently see in our region and in Curacao specifically might have to be enhanced in the future. So it's definitely something that we should monitor. In this respect, I find Mitchell Carmen's article on substance requirements in Curacao a good read, as it basically explains that the substance requirements for the CIC are basically OECD based, while you notice the EU's Code of Conduct Group's influence when you take a look at the substance requirements for the territorial profit access, for example. So it really illustrates the different approach. Finally, just because we spoke also about the transparency rules in the beginning, just to close the circle on that end. Another thing to keep in mind is that by the end of 2020, over 41,000 exchanges of information have taken place, and that the transparency is only increasing. So as tax administrations are getting used to receiving all of this information and processing it, it would be also very interesting to see what exactly they will do with it and what it will lead to. I think with that, Daniel, basically I compared the two systems. At least I use the substance requirement as mentioned in step 2 for comparison purposes. I'm not sure whether there are any questions. I'm looking at the Q&A box and I don't see any questions. Maybe there are something in the group, or maybe you like to add something, Daniel?
Yeah, well, I can add, but maybe indeed, it's interesting to hear your ideas or views or questions, having heard all what Terence and I just explained to you. The messaging is clear. There's work to do. And of course, I mean, this is just a 1 hour high-level summary. Of course, if you have more detailed questions, we are always available for you to, to get in touch after this call, to have a more detailed conversation, maybe talk about, alternatives. So we have all this knowledge, right here in our firm. So don't hesitate to contact Terence or myself or any other expert in your contact group from EY. But that said, Terence, I think we can close the session. Thank you for your attention, at least from my side.
Yes, thank you all very much for your time.
Thank you, Terence and Daniel, for this interesting webinar today. You've given us, I think, enough food for thought to prepare actually for if these rules need to be implemented or adhered to by Curacao enterprises also. Thank you also for our members for participating. Stay tuned for our next webinar. More info to follow on that very soon. Thank you, guys. Have a great day.
Bye-bye. Have a nice day.
Thank you. Take care.